Hey guys, it's Sasha. In 2 weeks, on September 18th, the Federal Reserve will reduce interest rates for the first time since April 2020, when interest rates were sent straight down to 0%. And everybody is expecting the stock market to go to the moon when the rate starts dropping. But is that what's actually going to happen? Is the stock market about to go bananas? Is it about to go jubilant? Well, I want to share a slightly different take. When Jerome Powell announced that the time has come to cut interest rates in Jackson Hole a few days ago, the stock market began celebrating and popping the champagne. Last Friday, the stock market closed just below its all-time high, up over 19% since the start of 2024. Today, when the stock market opened, it's suddenly not looking as rosy. What happened? All the big tech companies on the left are red. Throughout August, the stock market was expecting the opposite of what happened in 2022 when interest rates started going up. Not just in August, for the whole of this year, really. In the first 9 months of 2022, the stock market fell 25% as interest rates started going up to combat inflation. Then ChatGPT arrived here, and big tech and any company in the AI space went up a few 100% overnight because everybody immediately made the mental leap from a chatbot that doesn't suck to the world switching everything to general artificial intelligence sometime in the next year. So those stocks absolutely exploded, and the stock market on average went up as a result. But those companies went up massively, but the rest of the stock market has still gone absolutely nowhere in the 2 years since that drop in 2022. So now the expectation is that the reverse is going to happen. Rates are going to start falling, small companies are going to benefit massively. Companies with debt are going to benefit. The cost of borrowing will go down. Stocks are going to go to the moon. Investors will begin flooding money back into those companies because bond yields will drop and everyone will want to be part of this new massive stock market explosion, and the stock market is going to explode. Stocks will go up 30 or 40%, but the important thing to think about is this. Is the reason why interest rates are going down the inverse of the reason why they went up in the first place? Or is the reason this time around fundamentally different? Because if the reason for rates falling now is very different, then the outcome might also be very different instead of being the inverse of what happened last time. A few days ago, the PCE inflation number came in, that's the Fed's preferred inflation metric, and it fell to just below 2.5%. At the same time, the upper bound of the Fed interest rate right now is at 5.5%. So the interest rate at the moment is sitting at over double the rate of inflation, 3% higher. The last time this happened was at the start of the financial crisis, when inflation was also around 2.5% and the interest rate was exactly the same as now. But the time before that, it also happened in 1994. And the situation in 1994 was very different. Inflation was at just 3%. And before the rate hike started, inflation rates were also sat at 3%. They were the same. In a year and a half, the interest rate doubled to 6%, but while interest rates were going up, inflation was actually going down. Interest rates went up and stayed up in 1994 because there was a sudden increase in market uncertainty over long-term interest rates, a whole bunch of stuff going on, bond yield discrepancy between different time horizons. But in 2007, interest rates went down because the Fed was panicking as the financial crisis hit. This is a chart of the US federal funds rate, and you can see that starting in August 2007, the interest rate went down to zero pretty quickly as banks were collapsing. The same exact thing happened in 2000 when the dot-com bubble burst, and there's plenty of other examples before that. But after the 1994 increases, the interest rate never really came down. The interest rate was a lot higher than the rate of inflation all the way from 1994 to 2000, and this period is also the best performance period in stock market history. The stock market went up 200% in those 6 years. When the rates came down in a sudden panic, the stock market lost 50% each time because the rate cuts were reacting to the market, not the other way around. The big question now is the Fed reducing rates from a position of strength like in 1995? Everything is great, soft landing achieved, the economy is booming, interest rates don't need to stay as high as they are right now. They can just dip a little bit lower. Everything is going to be great. That's the impression that Wall Street has right now, it seems. That's the message that the Fed is selling. That is what the media is printing every single day. But what if the truth is that the Fed is now panicking, that they have kept rates too high for too long? What if they realize that in a month or 2 months' time? In July's inflation data, we saw that all discretionary spending put together fell into deflation for the first time in a very, very long time. I went back a few decades and I couldn't find the last time that this happened. In the last 6 months, food inflation has sat at 0% and might be the next category to dip into deflation. House prices in the US fell in June, the latest data that just came out after being flat in May. Mortgage rates have fallen 0.5% in the last month as interest rate cuts are approaching. Retail prices on food and clothes appear to have dropped at the end of August, with Trueflation showing a 1.2% rate of inflation in the US. At the moment, the market seems to be expecting a 1990s style rebound. The consensus is that we're just at the start. The Fed will be reducing rates from a position of strength. The AI is only just getting started. Everything is going to blow up. It is the good times. Soft landing and all that. But that sentiment can change pretty quickly. If the first rate cut is just 25 basis points, then the impact of the rate cuts through to the end of the year will be relatively small and only come through in terms of limited effects starting sometime next year. In the meantime, unemployment rate has started increasing very fast. It's up to 4.3% now. We'll get the next update for August in a few days. Wage growth in the US is slowing down, while at the same time the average number of hours worked is going down every month. Oil and gas are both trading lower than this time last year, so there's a chance that energy inflation will remain flat or go negative in the next few months. So what happens if instead of the Fed reducing rates from a position of strength, the Fed is actually going to reduce rates fast in panic mode to stop deflation, to stop the economy collapsing because they massively over-tightened? Well, if that happens, then the rate drops themselves are no longer the driving force of what's happening in the economy. They become a reaction, an attempt at mitigating the situation. If this was a football game, then instead of attacking and trying to score with an intricate play, the Fed would suddenly be defending deep, standing on their own goal line. Here is what's actually happening in the US economy. People have run out of money, credit card usage has gone right up after COVID, and at the same time the personal savings rate is the lowest it's ever been, except during the financial crash, down at 2.9% in July and falling sharply. Inflation and poor economic decisions by the government mean that people are suffering. This is not the bullshit rose-tinted stuff that the Fed talks about or that you read in the media. This is the harsh reality, the real data of what's happening and what happens when the Fed over-tightens. So now that people have run out of money, they have stopped spending. I talked 2 weeks ago about how all discretionary spending is now in deflation. Cars, TVs, furniture, appliances, clothes, toys, everything that is not absolutely necessary to buy is now in deflation. Prices on those things are falling. This is not the same thing as disinflation. Disinflation is when prices are still growing, but the rate at which they are growing is reducing, right? They're not growing as quickly. No, right now, the prices on discretionary spending in the US are falling because people don't have the money to replace their old car or their old TV with a new one. So demand for those things is dropping. And the companies making cars and TVs are having to drop prices to keep selling. Now we're seeing a deflationary pattern emerge in food. The PCE index for food hasn't moved in the last 6 months, neither has the CPI. This is important because food is next in line of what you would expect to start falling in price in a typical deflation spike. Because the only other things available, the only things that are not part of the discretionary group are things like rent and mortgages, energy and finance payments, and things like insurance. No, finance is things like credit cards, loans, car payments, stuff like that. Before you go defaulting on your credit card or stop paying your electricity bill, you will cut back on food spending. That's how it goes. You'll start replacing more expensive food items with cheaper ones. You'll buy chicken instead of steak. You'll buy more grains and potato and less meat. So as a result, we'll probably see the effect of food spending in PCE data before we see it in CPI data, because CPI data shows you the change in the price of individual things. It only changes the weights, the distribution of how much those things go into the overall total of individual items once a year in January. So if prices of things stay the same, but less people are buying meat and more people are buying potato, you won't see that reflected in CPI data. But you should see it come through in PCE data, because PCE tries to track the total spending in the different categories. So total spending on food may go negative before we see the prices go down as a reaction. At the same time, you should see delinquencies begin increasing on less important financial payments. Car payments and mortgages are relatively protected, insulated. People don't want to lose their home on their car, right? But people don't care as much about getting a $30 late payment fee on their credit card if they don't have the money to pay the monthly bill and they have to choose to not pay something. And what do we have here? Look, what's happening with credit card delinquencies. 11% of credit card balances in the US are now 3 months behind on payments. The last time there was a spike like this was during the financial crash. Notice how mortgage delinquencies have not started going up at all. It's the orange line. They started going up quite fast in 2007 and 2008 because mortgages were the thing that crashed the whole system. They were the front runner. But if there is a general financial downturn scenario, a general financial meltdown, you only expect to see mortgages begin ticking up later on because people stop paying other things first. But look at the yellow line on these two charts, the yellowy orange line. See how the number on the left, people who go 1 month behind on their mortgage, is creeping up, but the line on the right is not. That's how many people are 3 months behind. So people are struggling. Sometimes their monthly payment bounces now, a lot more than it used to, or people don't have the money to pay that monthly payment. So they might go a few days behind, but then they go and work it out. They go find the money somewhere. They take on more debt, maybe borrow on that credit card, take out a loan, something like that. Maybe they spend less on food and on discretionary items. Maybe they have to wait until the next paycheck arrives. But then when that happens, they do go and get that mortgage payment paid because it's really important. So the number who missed the first payment has doubled in the last few months, but so far, those people are figuring out how to stop it getting worse, how to stop it rolling further towards repossession territory. Also, mortgages benefit from being somewhat sheltered from inflation. If you don't buy a new house, if you took out your 30-year mortgage before the inflation happened, then your mortgage payment stays the same, while everything else goes up 20, 30, or 50% or whatever. So relatively speaking, making that mortgage payment is, well, in a way, easier because it just stays the same. You can budget for it. But what happens if food dips into negative territory in the next 3 or 4 months? What happens if finance payments and energy also follow? And what happens if then people who missed the first payment on their mortgage don't suddenly have a way of figuring it out and, begin missing the second and the third payment? Well, the Fed is going to do a U-turn and they're going to be dropping that interest rate very, very fast. But the problem is going to be that the damage has already been done. It's a bit like building a shed and then noticing that your wood has completely rotten. And at that point deciding, well, maybe we should apply some treatment to the wood, to stop it rotting, to stop it getting worse. And yeah, sure, okay, if you do that, maybe you'll save yourself a few extra months, but the damage is already done. It's already broken. And maybe you should have done that treatment a year and a half ago instead. This morning, the ISM Manufacturing Activity Index came in at 47.2, below expectations again, and most importantly, below 50. Again, this means that US manufacturing is contracting. Factory output is dropping and has been dropping for 21 out of the last 22 months. Do you know when it started dropping? In October 2022, right after inflation shot up. The Fed was way too late dealing it with back then, and then the stock market fell 25%. From November 2022, the stock market has been going up because of AI, but the reality is that the US economy is struggling. Elon Musk just posted on Twitter that xAI, his new AI company, just launched their Colossus supercomputer. It has 100,000 H100 graphics cards and will double in size in the next few months. Including all the peripherals, that's something like $4 billion worth of graphics cards bought by just one AI startup, and they're going to spend that much again. And then there's OpenAI, Google, Microsoft, Apple, Tesla, and dozens of others doing the same exact thing. When you add up all of those numbers, it is insane. And they have converted into this huge stock market increase for AI companies that we're seeing, this insane bubble. And in exactly the same time, since that started, since late 2022, factories in the US have been in decline every single month except for one, and regular people have run out of money. The Fed has been too busy looking at overall numbers and not understanding the detail. There's not even any detail in PCE data, which is their preferred metric. You can't even go and dive into any of the subcomponents. The overall numbers have been masked by the AI hype wave. At the moment, the majority expect the Fed to only cut rates by 0.25% at the September meeting. The market is pricing in a 70% likelihood that the interest rate will only drop by 1% or less by the end of this year. And there are 3 meetings in total before the year ends. So the expectation is that at each of those meetings, it's only going to be a very small drop. So the market is currently expecting a very slow reduction in interest rates. The latest projection materials from the FOMC from the June meeting show that the majority of the members expected the rates to stay above 5% at the end of 2024. 4 of those people thought that the rate would not come down at all this year. In June, 2 months ago. And then almost all of the FOMC members said that they expect the rate to be above 4% at the end of 2025, at the end of next year. This is incredible. It's shocking. It is abysmal. It's shocking and abysmal because this is clearly showing that the Federal Reserve has no fucking idea what it is that they are doing. Again, they are saying it, they're showing you what they think is going to happen. I have absolutely no idea how just a few weeks ago, those Tweedledums could reasonably expect to not need any rate drops at all this year and hardly any next year. I don't understand how anybody who has any brain cells in their head, who understands the most basic economic principles, can be so exceptionally wrong. I don't get it. Then again, those same idiots back in December 2021 thought that interest rates would not need to go up above 1% in 2022. Remember, inflation at that December meeting in December 2021 was already at 7%. And a year later, instead of interest rates sitting below 1%, the interest rate was already at over 4%. I keep seeing CNBC and the YouTube finance space listen to every single word that Jerome Powell says, as though it actually matters. They cling on to every single word. Oh, was Jerome Powell slightly more hawkish or dovish or maybe parrotish, whatever? Or did you notice he used this word instead of that word? Oh my God, this is so important. And that means that maybe interest rates are going to go down slightly faster or slightly slower. Every single word is so important. None of that matters. Jerome Powell and the Fed are 100% completely full of shit. Just like they were a year ago, just like they were 2 years ago, just like they were late in 2022 with increasing rates by over a year. They are once again over a year too late reducing interest rates. And just because right now everybody's expecting a slow reduction and a soft landing doesn't mean jack shit. If unemployment creeps up towards 5%, if inflation numbers go to 2%, but don't stop there and keep on going down towards deflation, the Fed is going to have no choice. It doesn't matter what Jerome Powell said. It doesn't matter what they're thinking. We're in September right now. And in 2 weeks, we're going to get the August inflation data. Right now, the overall inflation level is at 2.9%. August inflation last year went up 0.5% month on month, and in September last year, it went up 0.4% month on month. If inflation for August and September is around 0%, then inflation in September, the month we are in right now, is already at 2%. So the Fed has been waiting for evidence of when they should maybe start cutting interest rates, and the first month in which they actually start doing it, inflation is probably already sitting at around 2%. It's a bit like driving down a road at 80 miles an hour and seeing a red light ahead at a busy intersection. The way that the Fed drives is this. You keep going at 80 miles an hour. You do not slow down. You tell all the passengers that you might need to accelerate to 100 miles an hour to make sure that you get to the red traffic light a little bit faster to show them that you really mean business. And then when you are exactly level with the red traffic light, as you are entering the intersection, still going at 80 miles an hour, only then you start pressing the brake pedal, but you do it very gently, just a 25 basis point drop. You don't want to press it too hard, because it might be uncomfortable for the passengers. You don't want that. So you just plow right through the busy intersection, through the red light at 80 miles an hour. And Jerome Powell, who is the driver, says, well, we had to get to the red light first before taking action. That's our mandate, right? It was impossible to know 200 yards earlier that we should slow down. Absolutely nobody could have seen it coming. What if I pressed the brake too early and we didn't get to the traffic lights at all? The next few months are now very, very risky because the Fed completely fucked up. There's a chance that the US economy pulls another rabbit out of a hat. It's happened before. It could happen again. But the data is just not looking good. And it's incredibly frustrating because this was extremely predictable. It was incredibly obvious and it didn't have to happen.